To the Federalist Society for Law and Public Policy Studies, and I'd like to thank everyone for being here tonight. I could just about read this without the glasses, but it goes much easier with the glasses. So I'll tell you a little bit about the Federalist Society. The Federalist Society for Law and Public Policy Studies is a group of conservatives and libertarians interested in the current state of the legal order and dedicated to its reformation. It is founded on the principles that the state exists to preserve freedom, that the separation of governmental powers is central to our Constitution, and that it is emphatically the province and duty of the judiciary to say what the law is, not what it should be. The Society seeks both to promote an awareness of these principles and to further their application through its activities. Now, tonight we're very fortunate to have a native, not only Long Islander, but Mineola native, who's now serving the legal profession as a professor in Iowa. I don't know how that
Things
works.
happen. What can I say?
But Robert Miller joined the faculty of the University of Iowa College of Law in August of 2012. Before coming to Iowa, Professor Miller was a professor of law at the Villanova University School of Law and the Associate Director and Acting Executive Director of the Matthew J. Ryan Center for the Study of Free Institutions and the Public Good at Villanova University. He has been a visiting professor of law at the University of Pennsylvania Law School, a visiting assistant professor of law at the Cardozo Law School, and an Olin Fellow in Law and Economics at the Columbia Law School. He has also held the Cyril. Two wines and you can't get the Cyril Youth Legal Scholars Fellowship from the Cyril Freedom Trust. Before entering academia, Professor Miller was an associate at Wachtell. Oh, here we go again. Lipton. All right, I think I get the rest of the names. Lipton, Rosen, and Katz in New York. His scholarship concerns corporate and securities law, the economic analysis of law, and the philosophy of law. Professor Miller earned his J.D. from the Yale Law School, where he was a senior editor of the Yale Law Journal, and an Olin Fellow in Law, Economics, and Public Policy. He earned his M.A. and Master of Philosophy degrees in philosophy from Columbia University, where he held a Mellon Fellowship in the Humanities from the Woodrow Wilson. Is he one of the guys we like or not?
The foundation is
No,
okay.
we don't.
All right. I actually went to a couple of their award dinners in Manhattan. The Woodrow Wilson National Fellowship Foundation and a Western Civilization Fellowship from the Intercollegiate Studies Institute. He earned his BA in Philosophy and Mathematics from Columbia College. Professor Miller teaches mergers and acquisitions, law and economics, corporate finance, business associations, antitrust, and contracts. Professor Miller has previously addressed the Federal Society National Lawyers Convention as well as a number of the Society's lawyer and law school chapters and has published numerous academic and scholarly articles, too numerous to recite here. At this point, I will bring you Professor Robert T. Miller. Thank you.
Well, as Mike said, I am originally from Long Island, so it is always an honor and a pleasure to talk to Federalists, but more so in my hometown, and even more so the Long Island chapter. I was at the Midwest leadership meeting of the Federalist Society a few weeks ago, and one of the documents showed growth rates in the various lawyers' chapters around the country. Your chapter has by far the highest growth rate in the country, 270% year over year. Your nearest competitor was down at 130%, so you're beating your nearest competitor by more than a factor of 2. So thank you very much for inviting me here tonight. I'm talking about who caused the financial crisis. So the first thing we need to do is sort of nail down, in a rough and ready sort of way, what I mean by the financial crisis. And that really has two aspects. The first is that in the middle years of the last decade, say from 2003 through 2007, there was a gigantic bubble in the United States real estate market. Right? Housing prices went up much more per year than they had in the past, and eventually those prices crashed. So it's a typical asset bubble. Now, those housing prices went up because people were buying houses with borrowed money. Right? They bought mortgages. those mortgages were securitized into asset-backed securities, many of which were re-securitized into higher type of derivative securities like collateralized debt obligations, some of which were again re-securitized into CDO squareds. On top of that, there were other derivative securities like CDSs written on top of CDOs. So ultimately, the drop in housing prices caused the value of all these securities to drop, which resulted in losses for all the people who held them around the country and indeed around the world, right? So there are two aspects. There's the bubble in the housing market, and then there's the fallout of the bubble, which is spread through this hierarchy of securities around the world to whoever held them. So our question is, why did this happen? Now, there's a popular account of why it happened. It's very simple. It goes like this. It's all the fault of a bunch of greedy Wall Street bankers. Now, what did these greedy Wall Street bankers do in this story? It starts like this. It says what the bankers did was they tricked a bunch of people who had no business taking out mortgages into taking out mortgages to buy houses they couldn't afford. How did they do this? Well, mostly with subprime mortgages. Subprime mortgages have these low introductory teaser rates, which tricked people into taking out mortgages because they thought they could afford them, but they really couldn't. And after 2 or 3 years, these rates reset much higher than the teaser rate, and then suddenly these people discover they can't afford the mortgage after all, and therefore the mortgage goes into default. And this is like the first part of the story, tricking people into taking these mortgages they couldn't afford. Now, if you think about it for a second, lending money to people who can't pay you back doesn't sound like a great plan for getting rich. Right? So this can't possibly be the whole story. You don't make any money by lending to people who can't pay you back. So how did the greedy bankers do this? Well, it turns out that this set of greedy bankers, the mortgage originators, took the mortgages and then tricked another set of greedy but apparently quite stupid bankers into buying them from them. And these bankers then collected the mortgages, packaged them up into asset-backed securities, and sold them to even stupider people, right, who bought them down the line. Right? So there are two aspects to the story: tricking people into taking mortgages they can't afford, and then passing off the risk, right, first to other bankers and then eventually to ultimate investors who got left holding the bag. This story is false in every particular. So let's start talking about subprime mortgages, and then we'll talk about securitizations. Subprime mortgages came about in the following way. Back in the 1970s, when my parents bought their first house, which is about a mile up here right off Willis Avenue, actually, this is how they did it. They went to a bank where they were known, where they had their savings account and their checking account, and they met with a loan officer. And they produced a whole bunch of documentation: tax returns, pay stubs, from my father's job, letters of recommendation from his boss and other leading people in the community. And this loan officer analyzed all this information and probably checked up on the references, right, and did a very individualized bit of decision making to finally decide whether or not my parents deserved the loan, and if so, at what rate. Now, this system was good and bad. It was good because basically anybody who could prove that he deserved a mortgage could get one, because you had a chance to meet one-on-one with somebody and present all the relevant evidence. And this person was willing to analyze it and go out and investigate. But it was bad too, because this is a very expensive way of making decisions. You need to collect a lot of information, you need to analyze it, and you need pretty competent, intelligent people to be loan officers who make these decisions correctly, and honestly, we're just not giving out loans to their friends. So it was very high cost, which meant that interest rates had to be higher for the bank to cover these costs. Starting in the early 1980s, the banks figured out there might be a better way of doing this. In the typical pattern of capitalist economies, they figured out how to substitute capital for labor. They figured out that they could computerize this. The fact that computers are penetrating the business market in the early 1980s is important here. They figured out they could produce automated algorithms that would take things like people's income, their credit scores, which also began to be very big in the 1980s, and they could automate this decision and firewall the loan officers. Now, this was good and bad too. It was good because it was cheap. That meant that banks could process loan applications much more cheaply than they did in the past, which meant that ultimately they could charge lower interest rates, which meant that more people could qualify for loans and buy houses. That's all to the good. But it was bad too, because all the banks used basically the same type of algorithms. And so it turned out that if you couldn't get a loan at one bank, you weren't going to get a loan at any bank, because pretty much everybody used the same criteria. And even worse, the banks quickly figured out through the 1980s, by around 1990, that there were a lot of people out there who used to get loans under the old system, who were actually good risks, who failed the automated criteria. Those people weren't getting loans. So the banks would say to themselves, how can we possibly make money on these people? They're good risks. We want to lend to them. The problem is we can't figure out who they are. Because in our pool of people who fail our automated criteria, some of them are these good people, but others are deadbeats. And our automated criteria can't see the difference. So how are we going to figure out who, in the pool of people who fail the automated criteria, really deserve loans? The answer to that was the subprime mortgage. The subprime mortgage combines three important features. Number one, the low teaser rate. Number two, a very steep prepayment penalty. You can't refinance your subprime mortgage with a different bank without paying a big penalty. And number three, a rate that resets very high after 2 or 3 years. How did this help the banks? The low teaser rate got a lot of people to apply, which is what they wanted. The prepayment penalty kept them locked into a relationship with the bank who wrote the subprime mortgage. The really steep reset caused those people, when the reset rate hit in 2 to 3 years, to have to come back to the original bank and say, I can't pay this. But at this point, the world is very different, because now the bank has a lot of individualized information about this particular borrower. For some borrower, they have made every payment on time, their income has gone up, it has become more verifiable. The bank says, no problem, you don't have to pay that high rate. We'll write you a 30-year conventional fixed rate mortgage and pull you out of the subprime market and put you into the prime market, where in fact you probably always belong. For other people, they turn out to be deadbeats. They've missed every payment. They've lost their job. In fact, they've gone bankrupt and are in jail. Okay? For those people, these are people we never should have lent to. So we have to clean up this mess. What do? We foreclose on them. We cut our losses, take the house, sell it, repay ourselves, and we're done with them. And then there were a lot of people in the middle. They made most of the payments on time, but they were late sometimes. Their income might have gone up, but it's still not very verifiable. We're not sure what class they belong in. You know what we do with them? You write them another subprime mortgage. Say, see you in 2 to 3 years. You're still on probation. Most of the subprime mortgages that went into default in 2006 and 2007 were second and third rewrites of subprime mortgages originally issued in the 1990s. Subprime mortgages were a sorting device, a way of figuring out who, in the great pool of people who failed automated underwriting criteria, were actually good risks and who were actually bad risks. If you wrote large numbers of subprime mortgages, you could make money doing this. On one condition. When you had to foreclose on the deadbeats, you got your money back. Which meant the house had to be worth at least as much as the principal you lent against it. As long as that worked out, you'd lose money on the deadbeats, but you'd make money overall. So that's why subprime mortgages exist. What about the securitization part? Did people, mortgage originators, pass off bad loans, bad loans to unsuspecting investors? This never happened. Why? Because this whole problem of one person making a credit decision, deciding to extend credit, and then selling the loan, all right, selling the rights to repayment, this has existed for an extremely long time in a wide variety of contexts. And it's never been about fraud on the one hand, people committing fraud and selling off the obligations to somebody else. This began at least in the early 1980s with the syndication of commercial loans. Big bank makes a commercial loan to a business and then turns around and syndicates it, sells parts of it out to other banks. It's exactly the same pattern. And securitization exists not only with subprime mortgages, but with prime mortgages, and has done so for 20 to 30 years. It exists with car loans, and has done so for 20 to 30 years. It exists with credit card receivables. It has done so for 20 or 30 years. Student loan receivables. You belong to a gym, you pay a monthly fee. A lot of gyms and health clubs securitize those receivables. Any kind of reliable cash flow can be and has been securitized for an extremely long time. The critics who think there's a moral hazard problem here, one person wrote the subprime mortgage and then sells off the right to repayment to somebody else, they didn't discover that moral hazard problem. Everybody's known that exists. Everybody's known it for 20 or 30 years, and therefore, securitizations as well as syndications, reinsurance, which is the same problem, are structured to prevent the moral hazard from being significant. How? In a lot of ways. One is, when you write a subprime mortgage, you can't instantly get rid of it. In fact, to get rid of it, you have to securitize it with thousands of other mortgages. So you end up holding the mortgage yourself, usually for about 10 months to a year. Right? The reason Citibank lost about $50 billion in the crisis was it had warehoused thousands of mortgages and asset-backed securities based on mortgages that it was going to sell off to other people, and when the crisis hit, it took tremendous losses on it. But even beyond the warehousing problem, when you securitize a bunch of assets, no matter what they may be, and you sell off tranches of the securities, guess who has to keep the bottom tranche? You do. The first dollar of loss is yours. If this deal goes south, the first losses are all on you. There are other aspects to these deals. You securitize a mortgage that goes into default within 6 months or a year, it varies from deal to deal. You have to buy it back at full value. You can't just write crappy mortgages and sell them to other people. People aren't stupid that way. And especially when it came to mortgages. If you look at how mortgage originators' businesses work, part of their business model is when they securitize mortgages, they keep the servicing rights. The rights to collect the payments, run the escrow accounts, make sure the payments come in on time, pay the property taxes, and so on. Those rights are valuable because they receive a fee for doing that. Their business model does not work if they do not collect these fees. It's perfectly obvious from their income statements. They need those fees or they do not turn a profit. When a mortgage goes into default, that mortgage servicing right becomes a loser because you spend a lot of money chasing deadbeats and you don't get a bigger fee for it. So the only way you make money as a mortgage originator, selling your mortgages off, securitized, and keeping the rights, most of those mortgages, a large percentage of them, have to be good. Because if they're not, you're losing money. Proof of the fact, when the crisis hit, and all these securitized securities lost tons of money, everybody who originated them went out of business. Okay, because they retained huge amounts of risk. Countrywide, New Century, they all lost tons of money or went bankrupt. They did not pass off the risk to somebody else. They passed off part of it, but they kept plenty. Plenty enough to make sure that when the securities lost 10 or 20%, they all went bankrupt. Okay. So that story, which is kind of a left-wing story, is simply not true. There's a right-wing story about the financial crisis, too, that's also not true. That story goes like this. Back in 2000, the tech stock bubble burst. And the reaction of the Federal Reserve was to cushion the impact of that by lowering interest rates. And then, in 2001, the terrorist attacks happened. And the reaction of the Federal Reserve was to lower interest rates again to cushion the shock to the economy. And then, the Federal Reserve not only lowered rates, but lowered them to historic lows. This is true. And in 2003 and 2004, the federal funds rate sat at 1%. How low is that? If you look at the average federal funds rate from 1913, when the Federal Reserve was created, until 2003, the average rate was 5.2%. This was at 1%. It had never been that low. In the United Kingdom, the Bank of England performs the same function as the Federal Reserve. Its equivalent rate had never been lower than 2%. Never since the bank was founded in 1694. And here's Alan Greenspan at the Federal Reserve keeping interest rates of 1%. This story continues by saying, well, if you keep interest rates really low, what that means is you're generating a lot of money. Right? Federal Reserve open market operations are putting a lot of money into the market to keep interest rates that low. Where did that money go? The story continues. It went into the U.S. housing market. it inflated a gigantic real estate bubble with all that easy money the Federal Reserve created. And then, in 2006, the Federal Reserve started to tighten. So naturally, what happened? The bubble burst in 2006 and 7. Here's why this story is not true. First of all, it's not clear rates were always that, or quite that low. The Federal Reserve, since the early 1980s, has followed the Taylor rule, named after John Taylor at Stanford. And Taylor, naturally, thinks the Taylor rule is very good. And he points out that in 2003, 4, and 5, the federal funds rate was way below what the Taylor rule would have predicted and would have required. The problem is, if you calculate the correct Taylor rule rate, the way John Taylor does using the CPI, he's right. The Federal Reserve doesn't use the CPI. The Federal Reserve uses the personal consumption index. If you calculate it using the PCE, it turns out the rate might not have been all that low. But there's a more important reason here. If the Federal Reserve creates too much money, what you would expect is not a real estate bubble. What you would expect is the money to flow evenly throughout the economy, and you would get general price inflation. That's what happens when the Federal Reserve leaves interest rates too low, too long. You get general inflation. There was no inflation, or not high inflation during this period. There was normal levels of inflation during this period. Why, on this story, did all the money go into the U.S. housing market instead of just more or less spreading out evenly across the economy? People who tell this story say, well, there's a reason for that. The reason is that in the United States, we have all kinds of government subsidies that channel money into the U.S. housing market. Like what? Well, like the fact that your interest on your home mortgage is tax deductible. Other types of personal interest generally is not. Interest on your credit cards is not, interest on car loans is not. This is a subsidy for home ownership, and it channels money away from other uses into the housing market. Another thing these people say is homes, your primary residence gets preferred capital gains treatment. You get much better capital gains treatment on your house than you do on stocks and bonds or other assets. This too draws money away from other uses and into the housing market. And it goes on, right? Because there are subsidies, other subsidies for home ownership coming in the form, for example, of Fannie Mae and Freddie Mac, who guarantee mortgages and buy them and then guarantee them, which also lowers interest rates and draws lots of money away from other uses and into the U.S. housing market. This is all true. We do have all these subsidies. There's a reason for them too, which is that people think that there are external benefits of home ownership and that therefore there's a reason for subsidizing it. But apart from that, this story can't be the whole story, because all these subsidies have existed for decades. They didn't come into being in 2003. They'd always been there. So if the Fed was creating too much money, why did it slosh into the U.S. housing market only in 2003 through 2007? It can't be because of these subsidies. They've always been there. And so this can't be the correct story, I think, either. So what is the true story? Before I tell you the story, I have to do two concepts. One is the concept of an old-fashioned bank run. The other is the concept of an old-fashioned asset bubble. How does old-fashioned bank run work? How does traditional banking work? It was the old 3-6-3 rule. You borrow from your depositors at 3%. You lend out at 6%. And you're on the golf course by 3 o'clock in the afternoon. Banks borrow short-term. Okay? They borrow from people who have checking accounts and savings accounts there, who can come in and demand their money back at any time, pretty much. Right? Or even if they're selling CDs, the CDs are, usually 5 years and under. They borrow short-term. They lend long-term, 30-year mortgages, 10-year commercial loans, and stuff like that. Okay? This creates a problem for banks. The problem is that if, for some reason, the depositors lose confidence in the bank and worry that it becomes insolvent, they will come and run the bank. They will want all their money back. The problem is the bank doesn't have on hand enough money to pay back everybody because it invests it in these loans. So if everybody all at once shows up and wants their money back, the most the bank could do would be start selling off its loans at fire sale prices. It will not get full value for them, and the bank will end up becoming insolvent, even if it wasn't insolvent to start. Banks are runnable, and the reason they're really runnable is that the depositors have a collective action problem. If the depositors could get together and say, look, maybe our bank's insolvent, maybe it isn't, but it would not be good for all of us to pull the money out all at once, because if we all do that, then for sure we're all going to end up taking losses. What we ought to do is agree to leave our money in and make sure and try to make the bank work. So if you remember the great scene from It's a Wonderful Life, right? You have the Bailey Building and Loan, right, which is basically a bank, and Jimmy Stewart's drunk uncle has lost, a lot of money, physically lost a pile of cash, and then this rumor starts in Bedford Falls that the Bailey Building and Loan is insolvent, and everybody shows up and wants their money back all at once, right? And they're all, it's a small town, and they all know each other, right? So Jimmy Stewart has everybody in the room, and he says, now, Mabel, you don't need your money back, it's safe there in John's house, and so on. And he calms them down by explaining that their money is safely invested somewhere else. If you can collect everybody and get them to act collectively, you can stop a run. In the real world, you can't do that because there are too many depositors. So that's how old-fashioned bank runs work. The other concept is a bubble. Why are bubbles coming back? Take the tech stock bubble in the late 1990s. In 1994 and 1995, there was a new thing in the world. It was called the internet. And I mean really new. Right? In 1996, when I had my first summer job at a major New York law firm, that law firm did not have email. And the reason they did not have email was they didn't think it was safe to connect their computers to this internet thing, because we have a lot of confidential information at our law firm. Okay, so we'll have one computer attached to the internet and we'll put that in the library, but not the rest of our computers. Right? We couldn't do that. Right? By 1997, they had all their computers attached to the internet. 1994, 1995, 1996, there was a time when the amount of data moving across the internet was doubling every 100 days. That is a phenomenal growth rate. Back then, everybody knew that some people were going to get very rich on this thing. But nobody knew who, and nobody knew exactly how rich. So people make bets on different companies for different amounts, and the aggregation of all those bets was the price of tech stocks. Now there are two possibilities. Either the collective bet was low, or the collective bet was high. If the collective bet had been low, the growth of the internet would have continued longer than people thought. Everybody would have been happy. More companies would have made more money. People would have realized stocks were undervalued, and they'd have gone up even more, and nobody would have noticed that the stock price had been wrong for a while. But if the guess turned out to be high, which it did, then it becomes apparent that the growth isn't going to go on as long as people thought, and not as many companies are going to make as much money as people had thought. And then it becomes apparent that the stocks are overvalued, and then they crash. So how do you get bubbles? You get bubbles when there is fundamental uncertainty about something in the economy. When there's a good thing, the internet, that we don't know how good it is. If you go back and look at other bubbles in the 1920s, bubble leading up to the bubble in the stock market leading up to the 29 crash, was driven by similar factors. There were two things. There was the rationalization of American industry, think Henry Ford, assembly lines, and so on. It was clear that factories were going to be a lot more efficient than they were in the past, which meant that they were going to produce a lot more goods, a lot more cheaply. That's a good thing. There was also the invention of installment plan purchases for large consumer goods. This meant that a lot of people could go out and buy things that before they couldn't afford. You put those two things together, it's obvious that American industry is going to sell a lot more products to a lot more people than it had in the past. How much more? Nobody knows. So they took a guess, and the guess turned out to be high. And when it became clear that the guess was high, you get a stock market crash. That's always how bubbles work. There's something good, but we don't know how good. We take a guess, and if the guess turns out to be low, no problem. If it turns out to be high, when we find out that it's high, when new information comes in and tells us it's high, then you get a crash. Okay. Those two concepts in mind. Why did we get a housing bubble? The answer is it was a demand side thing. Back in 1990, if you went and looked at what I will call institutional cash pools, large amounts of cash held by big corporations, not just banks, but non-financial corporations as well, if you went and looked at the amount of cash held by asset managers, mutual fund people, the mutual fund industry was in its infancy in 1990. If you go back and look at how much money that was, best estimate is worldwide only about $200 billion. But then the world changed in a lot of ways. Corporations have gotten a lot bigger on an absolute basis in that 20 years. They have also started holding a much larger percentage of their assets in cash. Think of Apple with $130 billion in cash on its balance sheet, right? It's an extreme example. And this cash management has become much more centralized, meaning that every day major corporations sweep all their cash into one account and it's managed by one person, usually the corporate treasurer, right, on a daily basis. Not just corporations, but mutual funds. Most mutual funds run many different funds, but you know what? They manage their cash centrally. The cash from all the different funds is swept into one account every day, managed by one cash manager. Securities lenders too. People, if you want to sell securities short, you have to borrow them from somebody. When you borrow them from somebody, you pay. They have cash pools they have to manage. These cash pools in 1990 were about $200 billion, as I said. By 2007, the number was $4 trillion. That's an increase of 20, a factor of 20. That is a tremendous amount of money. Now, let's say you're an institutional cash manager. You have a pool of about $1 billion you have to manage every day. What do you want to do with it? You're a big corporation, right? This is money that we're going to use next week for payroll, that we're going to use to fund that new factory. Right? This is money that we're going to need really soon. What do you want to invest it in? If you're an individual, where do you put your money like that? In a checking account. It's there when you want it. You're sure to get it back. It's insured by the government. So, do corporations stick their money in checking accounts? They can't. Because FDIC insurance was only at $100,000 in 1980. It's only at $250,000 today. You can't get insured deposits big enough for the amount of money you have to deal with. You could try breaking it up over many banks, but the problem is from 1990 to 2010 or so, the number of FDIC insured banks in the United States fell by almost half, from 15,000 to about 8,000. There simply aren't enough banks with insured deposits for you to break up your money into $100,000 or $250,000 pieces and put it everywhere. So what are you going to do with this money? You need it to be absolutely safe. You don't want to lose any principal. You want it to be immediately liquid so that you can get it back whenever you want it. What do you invest it in? The next thing is treasury bills. Short-term obligations of the United States government. Absolutely safe, U.S. government always pays, at least it has until now. And liquid. Can you invest it in long-term treasuries? No. You can't go out and buy a 30-year bond. Why? Because although the government is sure to pay off in every interest payment over 30 years and your principal back at the end, if interest rates change between the time you buy the 30-year treasury and the time you sell, you could end up taking a loss. Right? Treasuries are exposed to interest rate risk. If you buy a 5% treasury and interest rates go up in the interim, that treasury will trade below par. When you sell it, you will not get back 100 cents on the dollar. You'd have to hold it to maturity. And you can't do that if you're managing an institutional cash pool, because you need to make payroll next week. You need 100 cents back on the dollar. So, can you therefore, as an institutional cash manager, go out and invest in treasury bills? You could, but there isn't enough of them. If you go and track the size of institutional cash pools and the total amount of short-term U.S. Treasury obligations available over this time period, the gap opens tremendously. In 2007, the gap is at $1.5 trillion. There's at least $1.5 trillion that wants some type of super safe, ultra liquid investment, and there are not enough treasury bills in the whole world to buy. So what do? The answer is Wall Street comes to the rescue through what became known as the shadow banking system. We need to create, in the private banking world, assets that are 100% safe, 100% good against credit risk, 100% good against interest rate risk, and incredibly liquid. So how do you do that? Step one, you need something that has very little credit risk. Answer, asset-backed securities. You have a bunch of mortgages, thousands of them. You pool them up, you sell off securities, and the top tranche is super safe, and the next tranche is super safe. The chance of so many of those mortgages going bad that the first guy to get paid and the top tranche not getting paid is teeny, teeny, tiny. So you start off by creating very high credit collateral. But that won't do it all by itself, because these asset-backed securities would still be exposed to interest rate risk. People can't just go out, the institutional cash managers can't just go out and buy ABSs because they'd be exposed to interest rate risk. So what you need to do is what's known in the business as maturity transformation. The problem with asset-backed securities is they have long maturities, which expose them to interest rate risk. You need to take them down to very low maturities. How? A bunch of different ways. One way was the repurchase or repo market. So imagine you're an institutional cash manager and you have $1 billion to invest. You would go to an investment bank, a super safe one, say like Lehman Brothers, and you would, quote, deposit $1 billion with Lehman overnight. In exchange, Lehman would give you $1 billion worth of asset-backed securities. Tomorrow, you would return the asset-backed securities. Lehman Brothers would return your $1 billion with a little interest. And we've taken the asset-backed securities, which had long maturities, into one-day maturities. The repo market was the primary way that major investment banks funded themselves before the crisis. It was one of the biggest ways that cash managers invested their cash. How big? In 2000, it's right, the repo market is entirely unregulated, so it's hard to get good numbers on it. But in 2007, the best estimates say that the repo market was somewhere between 20 and 30% of gross domestic product. That's like $3 trillion in 2007. That is a huge banking market, resetting every day, right, on these overnight repos. Another way you create super safe investments out of ABSs is like this. A big bank, like Citibank, announces that it's going to create a prime money market fund. The money market fund takes deposits from institutional cash managers and others. Sometimes some are open to retail investors, some aren't. And what does it do with it? It invests it in an extremely broad array of asset-backed securities, asset-backed commercial paper obligations. And the idea here is that because the ultimate investors are indirectly invested in such a broad portfolio of asset-backed securities, the interest rate risk is diversified away. Prime money market funds, right, are managed so that each share bought for $1 is worth at least $1. Meaning that when you want your money back, you're sure to get it back at par. And not only are you indirectly invested in the asset-backed securities, but everybody always thought that the sponsoring institutions like Citibank would make whole the investors if in fact the asset value dropped below $1. And this in fact turned out to be true. They weren't legally obligated to do it, but everybody thought they would if push came to shove, and when push came to shove, they did. So you had excellent collateral, good diversification with a backup promise from Citibank. How big was this market? Height of the crash, $1.7 trillion. Okay. So these markets, these shadow banking markets, provide a way for these institutional cash managers to have super safe, super liquid investments. But you notice, ultimately, all this money, this $4 trillion, is ultimately indirectly invested where? In the residential real estate market for the most part. If you look at the amount of securitizations going on in the 2000s, there's a tremendous spike in the creation of asset-backed securities to fund the shadow banking market. That money is ultimately being made available indirectly to people who want to buy houses. When you make a lot of money available to people who want to buy houses, they can go out and pay more. If they can go out and pay more, prices of the houses go up. That inflates the bubble. By 2007, the bubble was really high. And then, right, in a traditional banking market, we stop bank runs with FDIC insurance. There's no FDIC insurance in the shadow banking market. So what happens? In early 2007, the value of certain subprime securities starts to fall because some people have figured out that, you know what, housing prices are just too high. They're not going to continue up on this trajectory. So certain people started selling off subprime asset-backed securities. From early 2007 to January 2007, up to August 2007, subprime security prices start falling. During that same time, institutional cash managers start withdrawing money from money market funds that hold a lot of subprime securities because they're worried that as those subprime securities lose value, maybe the money market funds won't actually be able to redeem their shares at par. They might not get back 100 cents on the dollar. So from January 2007 to August 2007, $350 billion comes out of the money market fund market. At that point, the money market funds have to start selling assets to cover these withdrawals. They can't do it. Right? As they sell more assets, the prices fall even further, right? Which makes even more people withdraw their money. The run is on. And the only way it stops is the sponsoring institutions, the Citibanks of the world, step in, take those money market funds onto their balance sheets, and agree to make everybody whole. That stops the run in 2007, but only temporarily. 2008, say from January 2008 to September 2008, because the sponsoring institutions stepped in and stopped the run, money starts flowing back into the money market fund market. So the deposits were down to something like $1.35 trillion in January of 2007. They go all the way up to $2 trillion by September. All that $350 billion comes back, and about that much more all over again. Where's it coming from? The answer was mostly the repo market. There's a very slow run in repo in 2008. As these asset-backed securities start falling in value, you can borrow less against them, right? So in the old days, if you were Lehman Brothers, and you had $1 billion worth of asset-backed securities, you could go into the repo market and borrow $1 billion against them. But now, your asset-backed securities have fallen in value. They're only worth $800 million. You can only borrow $800 million against them. And worse than that, the lenders are demanding, quote, haircuts. So in other words, if you have $800 billion worth of asset-backed securities, they'll only lend you 75% of that value against your $800 million. So they'll only lend you $600 million against your $800 million of asset-backed securities. You used to be able to borrow $1 billion, now you can only borrow $600 million, which makes it very hard for people who fund themselves through repo to continue funding themselves. So there's this slow motion run in repo as more and more people fail to, they buy repo, they get paid back the next day, and they decline to reinvest. Money is being sucked out of repo. Some of it is going into the money market funds. Other of it is being hoarded other places. By September of 2008, early in September 2008, a run starts on Lehman Brothers. Lehman funded itself primarily through repo, and people stopped re-upping with Lehman Brothers. They would not fund Lehman Brothers in the repo market. This, by the weekend of September 13-14, makes it clear that Lehman Brothers is going to go bankrupt. Over that weekend, the government could have saved Lehman Brothers and declines to do so. When the markets open on the morning of September 15, 2008, and it's announced that Lehman is going to go bankrupt, a run starts in the money market funds. Because, in particular, one fund, Primary Reserve, was thought to have a lot of exposure to Lehman. People started running the Primary Reserve Fund. When they started running Primary Reserve, it became clear that Primary Reserve was not going to be able to redeem at 100% on the dollar. They broke the buck. That started a run across all of the money market industry. Repo ended that day pretty much. Right? No one would engage in large repo transactions, and everybody wanted all their money back out of the money market mutual funds. only way that stopped is when the government came in and insured all of the money market funds. They said if the government in effect created FDIC-like insurance on the money market funds. That stopped the run of money markets, but it didn't stop other ones. Just like Lehman went bankrupt, all the other banks began to worry that their counterparties, other banks, would go bankrupt. They stopped lending to each other. The interbank market froze. When the interbank market froze, banks couldn't fund themselves in any normal way. That means, among other things, that they're going to hoard all the cash they have, and they're not going to lend to anybody because they're afraid of being robbed. When banks stop lending to people who are non-banks, they're normal customers, then credit dries up for them. And then the problem, which was primarily a financial problem, comes to be a problem for the real economy when credit ceases to flow into the real economy. That's how damage is transmitted from purely financial sector out into the real economy. So in this story, who caused the financial crisis? The answer is really no one. What you had was a banking market, the shadow banking market. In our normal banking markets, we prevent runs with FDIC insurance. There's no FDIC insurance in the shadow banking market. That makes it runnable. So you got an old-fashioned bank run in the shadow banking market. Imagine you had a situation like this. Imagine there's a small bank in a little western town surrounded by good land that's not developed. And some really rich guys on the East Coast announce that they're going to invest money in this bank. So this bank can go out and lend money to people in this little town to go out and buy and develop the land. And it's clear that there's a lot of money at issue here. But what would happen in that little town? People would borrow from the bank. They'd buy land. The land prices would rise. Suppose the land prices rise so high that people become convinced that, in fact, the people who buy this land are never going to make enough money farming it to repay their loans. Then land prices start to fall. You get a crash in the land price. At that point, it looks like the loans this bank made are going to go bad. So the depositors would run the bank on the East Coast. This is exactly what you have. The East Coast people are the institutional cash pools. The bank is the shadow banking system. The landowners are everybody who was taking out residential mortgages in 2003 through 2006 or so. What you have is a classic bank run in a very, very sophisticated setting. Now, when you see a gigantic human tragedy, like the financial crisis, people losing their jobs, businesses closing, right, immense hardship from a huge number of people, people getting foreclosed, and so on, the natural human reaction is to find the villain and blame him, right, to hang him up from the nearest light post. But very often in the world, it doesn't work that way. Often, it turns out that what you had was a system that was systematically vulnerable, and a trigger that made the vulnerability come to pass, namely subprime mortgages. And there is really, in my view, no one who is really to blame here. And that's a really unsatisfying answer. You need a very philosophical temperament to look at a human tragedy and say, it's just too bad, it's the way things are. But I think that it's actually the truth. So thank you for listening to me. I'm happy
Don't you think that the Barney Frank had anything to do with it, the government, where they encourage people to give loans to everyone, no matter what their income status?
If you look at how subprime, right, a lot of people who didn't deserve loans got loans in
That's
subprime
right.
mortgages.
Because the government mandated that they get them.
How did the government do that?
Because through the, whatever it was called, the homeowners.
Community
You ran HUD. All right, well,
You built like
all right, well,
It was the community
And they
reinvestment
forced
act.
banks to give bad.
Cuomo even said it felt like he was the head of HUD.
if you look at the percentage of loans that could possibly be involved in the Community Reinvestment Act, it is 3% of the value of the run-up in housing
I
prices.
don't believe that.
It's just
gotta be,
very small.
you know,
Look, if you're Jamie Dimon and you're running J.P. Morgan, okay, and Barney Frank is pressuring you to make bad loans, here are two options. Crash your bank and lose billions, or donate $200,000 to Barney's next re-election campaign. The great thing about politicians is that they're cheap dates.
I'm just saying on the moral.
But during the Home of America, didn't they have like 90% of these loans? No one got prosecuted from Angelo, whatever the hell his name was?
Countrywide.
You're talking about Countrywide, right?
Yeah, countrywide,
All
right.
The
No-
only
nothing happened to
securities
them?
fraud claimed about Countrywide was
And then
not
Bank
that
of
they
America took
misled,
over all their debt.
Yeah.
Bank of America got in
not,
trouble, but
not that they misled
Countrywide.
the people to whom they were selling mortgages, but that they misled their shareholders. If you go and you look at the prospectuses associated with securitized assets, they say over and over again, quote with deathless repetition, this is from a case in Massachusetts, these securities may lose value. These securities are dependent on housing prices and so on. Nobody
That's
can.
all disclaimer. But,
Yes, but it's the truth in this instance.
but it's not. It's not the truth, because the government encouraged the loans to be given to people that would not ordinarily qualify. And not only that, but they got loans for more than what the house would cost, so that they also financed,
The seller's concession.
they financed that, and they also financed the furnishings. And these are people that we all mourned, and they made a big deal, hysterical deal about how they lost their homes. But these people didn't put anything down.
I
And
agree
we
with
all
you, but I'm
paid
not-
for
I
it
don't feel-
as Fannie and Freddie Mac, and that's what they should get rid of. And they should let banks loans, and they should let them make their loans based on what whom they deserve, who they feel is deserving of a loan, not what the government dictates is deserving of a loan. That's what happened. And you know, this crap about JP Morgan and all that stuff, I'm not gonna buy it, because Barney Frank was a big guy in this, and then he walked away and he didn't get prosecuted, and Angelo M, whatever his name is, didn't get prosecuted. They all benefited from it, and no one got prosecuted,
How did they benefit from it when their company went bankrupt?
because he made a tremendous amount of money. He bankrupted his company, he took all his money out.
Ma'am, if you look at the pleadings in that case, Mozilla is the ones whose emails are saying, we're taking on more risk than we should.
No. Mozilla was telling his stockholders that everything was okay.
Yes,
Okay?
and that's
At the
why.
very end, he told them that after it was way
All
too
right,
late.
you don't want to listen to them.
I'm not gonna listen, because it's not the truth. You're not actually.
Tough crowd. Yeah, Professor, with the, one of the things with Lehman that was
He's my
criticized
neighbor, I
was
know what
because
he's
the government
like
coming, well, they didn't really, they kind of negotiated the sale of Bear Stearns to JP Morgan. One of the things was because of that, there's criticism maybe Dick felt Lehman could have sold out. He kind of thought the government was going to bail him out, and he didn't move fast enough to. And the other question is, once the fallout came, I guess you could say the government did at least have to do the stopgap, and only because of market perception would kill the market at that mid-September. There's a lot of people saying they should just let it fail. I think that would have been disaster in the short term.
And excuse me, I just wanna clarify something about Mozilla.
No, you're done.
The taxpayers
Yeah,
actually
ma'am.
lost, because he got it with the subsidized loan. So we all paid for that. Fairfield Property now owns the building, which is a regular corporation, but we all paid for Mozilla losing. Nothing happened to him, he never got a fine. Okay, thank you, continue.
Thank you. All right, so there are two questions
The
here.
Bear Stearns one,
All right,
and
so
then the government prices.
Okay, so, first question, could Lehman have cut a better deal if they acted faster? That's really hard to say, you would have to have been in the room, I don't know. Should the government have saved Lehman? Oh, of course they should have saved Lehman, right? Anytime you have a classic bank run, right? Bank run is a collective action problem. By anybody's standards, by Milton Friedman's standards, one of the things government should do is stop collective action problems. Right? Lehman might very well have been solvent 6 days before the run started. There's no reason a solvent business should go bankrupt.
But as bad as it was, the government got criticized, at least the Bush administration, for saving after it. Had they not have acted,
Right,
then
I
it
mean,
would have
they
been-
saved Bear, they didn't save Lehman, and then they saved AIG, right? The
But if
single
they didn't
biggest-
save AIG, you would have had a collapse.
Yes, no, they should have, if they had saved Lehman, they would never probably had to have saved AIG,
I see, yeah.
all right? You wouldn't have gotten, the worst of the three runs.
And don't forget, it's only a temporary stopgap,
Yeah.
so perception doesn't, it's not.
Yeah.
Professor, in answer to the question, may I suggest the problem might have been caused, was caused by the likes of Sandy Weill, Larry Summers, Bill Graham, and Bill Clinton, With the repeal of the legislation that was on the books since 1930.
I mean the Glass-Steagall Act.
Yes.
Yeah, I don't think so. And the reason is Glass-Steagall prevented commercial banks to accept insured deposits from engaging in investment banking activities. Now, if you look at the banks that went down, right, Lehman, Bear, right, they were getting run in the repo market, and they are investment banks. They would never have been on the protected side of Glass-Steagall. Right? The big Glass-Steagall banks, Morgan, right, was not in trouble.
And isn't that why Goldman moved toward, to go to the Fed window to borrow money? Can you make an argument?
Goldman got forced into becoming
Oh,
back
because so
end
they could, well, they did it to borrow money, I guess, from the Fed Reserve, because they couldn't do it before.
Goldman was never in trouble, right, if you look at their financials, right? They got out of most subprime things long ahead of other people. They got out of most asset-backed securities long ahead of other people. Right? And for example, I remember Warren Buffett invested $5 billion in Goldman Sachs. Do you think he did that because he didn't think they were in good shape? He did that because he got a bargain. Right? From his point of view, he got a bargain. From Goldman's point of view, they got validation in the market. So, Goldman, nobody wants to go to the discount window. Going to the discount window is a disaster. Right? Citi and I believe Bank of America might have gone to the discount window during part of the crisis, but there's no way Goldman did it. There's no way they'd ever want to.
So that's not why they became into a commercial bank? Okay.
You've outlined a very complicated scenario about what happened. Are there any bromides, are there any simple solutions that we could enact legislatively that would have prevented what you just outlined?
All right, so the normal answer to a bank run is you insure the deposits. Right? When the government insures the deposits, you create a new problem, which is you have a moral hazard problem because the bank can now borrow very cheaply because everyone knows its deposits are insured. And the danger is they go out and do really risky stuff, and it becomes heads they win and tails the taxpayers lose.
Moral hazard meaning the government will back them out.
Yeah.
It'll protect their skin,
Exactly.
they have their
Right.
skin.
So the answer to that is if you give people FDIC insurance, then you have to go regulate what they can invest in. You can engage in the capital regulation of banks. So the question is, could you transfer that model easily into the shadow banking market? I could imagine some complicated way of doing it, maybe. Right? But there's probably a simpler solution. If the government changed its funding mix and sold fewer long-term securities and more short-term securities, there'd be no issue here, because the shadow banking market would never have existed. People who manage these institutional cash pools would buy treasury bills, they'd buy one-year notes, right, and they would have exactly what they want, highly liquid, highly safe, short-term investments. That's a much cheaper solution than going out and trying to regulate the shadow banking market. Now, there is a downside to that, too. The downside to that, too, is if you shift the mix of bonds the federal government sells, less long-term, more short-term, you expose the government to refinancing risk, right? So if interest rates, if we're borrowing all short-term, when we could be borrowing, we have low interest rates and we're borrowing short-term, and then interest rates go up, we have to refinance at a higher cost. Right? So there is a cost to doing it that way, but it's a much more simple and elegant solution, I think, than trying to regulate something like repo or regulate the money market mutual fund. So for example, there's a proposal now that says money markets will have floating net asset value. So instead of saying we're going to have at least, our stuff's going to be worth at least $1, it's going to float, which means that if you invest in this money market mutual fund and you cash out, you might not get 100 cents on the dollar. Okay? So that, right, would be one way of attacking this problem. The problem is that what the reaction to that is probably going to be is institutional cash pools just won't invest there anymore. They'll go invest somewhere else because what they want is guarantee back of their principal. So if you change that type of investment to make sure they're not getting a guarantee, they'll just move somewhere else. Right? There has to be a place for this huge amount of money to go to the kind of investment it wants. And if you stop allowing a certain kind of investment to be what it wants, it'll just shift somewhere else. Another simple alternative would be just guarantee the mutual funds, just like you do with FDIC insurance, or basically raise the FDIC insurance to an unlimited amount. Right? At that point, what you need to do is regulate the entities who are getting the guarantee to make sure they don't go out chasing yield and investing in more and more risky stuff. So that's the other possible way of doing it. But I like the solution of just selling more T-bills and less 30-year bonds. It exposes the government to refinance risk, yes, but honestly, probably the government is a better risk bearer of that risk than the investors anyway, right? So it's not all.
Yeah, I'd just be curious as to what your reaction is to Dodd-Frank as the reaction to this whole thing.
Yeah.
There's so many different things in Dodd-Frank, it's like hard to know where to begin. Okay, so there's a lot of really stupid things in Dodd-Frank. So here's one. Section 502 says that if you're a public company in the United States, and if you use any of the following minerals, including gold and tungsten, in any products you make, you have to look all the way through your supply chain and disclose where that gold and tungsten is coming from. Is there any gold and tungsten in my story? No. Why is this? Well, because in West Africa, in the former Republic of the Congo, there are some very nasty wars, which are in part funded by conflict minerals like gold and tungsten. And people in Congress thought it would be great if public companies had to disclose whether or not they were indirectly using conflict minerals. This is a completely moronic idea. It's using the federal securities laws to try to stop a war in West Africa. It's not going to work. If you look at the bigger provisions of Dodd-Frank, even some of the biggest ones have nothing whatever to do with the financial crisis. So for example, giving the SEC authority to tell public companies in the United States that they had to make their annual shareholders ballot open to shareholder nominations for directors. Maybe that's a good corporate governance idea, maybe it isn't, but once again, nothing whatsoever to do with the financial crisis. Even stuff that's obviously financially related, like regulation of hedge funds and disclosure by hedge funds. Hedge funds weren't the issue here. Right? Most hedge funds don't really actually have enough money to create systemic risk. Also, conceivably a good idea for other reasons, maybe, but not related to the financial crisis. If you look at what actually was related to the financial crisis, you probably have two things in Dodd-Frank. One is the creation of the Financial Stability Council, which is supposed to identify systemic risks and prevent them from occurring. Good luck with that. All right, there's no way the government's going to figure this out faster than the market. Never going to happen. Probably the best thing to be said about the Financial Stability Council is that it's never going to do anything. The other thing in Dodd-Frank is the Resolution Authority. That I think for distressed financial institutions, especially systematically important financial institutions. That too, taking them outside of normal bankruptcy and creating a tremendous amount of regulatory power in either the Fed or the comptroller of the currency, probably also not a good idea, but again, not really directly related to the crisis. One way you know that Dodd-Frank is not directly related to the crisis is that in early 2009, Congress commissioned a study on the causes of the financial crisis. They passed Dodd-Frank 6 months before the report came in.
Yeah, we can rely on that study. It's a government study.
Two questions. One, it seems you have you disagree with Peter Wallison's account of the financial crisis, but I'd like to hear where you think he's methodologically wrong, what the principal errors, especially when he points out that the 2/3 to 3/4 of subprime mortgages held by Fannie and Freddie, going to the government-centered explanation for the crisis. Second question is, what's your assessment of TARP, of the government's response? Do you think it was wise? And in the future, how would you go about responding to something like this?
Fannie and Freddie are able to invest in the high tranches of subprime securities. The total dollar value of what they have is not sufficient to inflate this market. And even if you think about it, right, where was the dollars coming from? Right, the reason that they were even able to do this, there had to be demand-side explanations for where the money was coming from. And Wallace has nothing to say about that. Right? So you get into very complicated statistical arguments over demand-side versus supply-side explanations. It's a good article by Mark Leviton and Susan Wachter, he's at Georgetown, she's at Wharton, and they have really good statistics that show it's the supply side. In other words, it's where the money is coming from, not the residential real estate market that drove the bubble. And as to TARP, look, on TARP, if you take out GM and Chrysler, right, which are not financial institutions and should never have been included in TARP, the government makes money on TARP. If you make money on TARP, what that shows is that when you went out and saved the banks, they were solvent. All right? They were investing at a good rate. Now, why would the government do this when the market can't? Because the market gets panicked. The government can afford to hold on to securities for an extremely long time. There are a few people in the world who can do that too, like Warren Buffett, because he has $40 billion. No surprise, he did exactly the same type of deal the government did in TARP. In fact, the TARP securities are modeled on the preferred stock that Warren Buffett got from Goldman Sachs. So since the TARP made money for the government, how can this really be a bad idea?
Are you kidding? Since when is the government our investment vehicle? The government is here to
Would you
serve
prefer that
us.
they had lost money?
I don't think they should have done it in the first place.
I'm not
I think
surprised.
that Buffett should have done it
Yes,
in the
please.
private industry.
Yeah, on September, whatever it was, 14th, and I was sitting at Shea Stadium, listening to the fact that my Lehman bond was worthless. But I kept saying to my wife, with my business partner, don't worry about it, it's rated AAA. Nothing can happen on Sunday. You left out, to me, one of the big culprits, which is like Moody's or the rating agencies. And that's my first question. The second question is, coincidentally, a couple of months ago, our administration in Washington has decided to indict the one new rating agency who gets paid by the clients rather than the company that they're rating. And now they were fined or whatever that was, coincidentally to this whole thing. And I just feel that the proper, like was said, the proper criminals really, I'm just a retail investor, and I don't like it either when the Corazons and the others walk away.
It's not
and
clear
nobody
Corazon
is
going to walk away, but
well, whatever.
it's long after the financial crisis anyway. That's a different story. But
I agree. I agree.
So, rating agencies. Here's the thing about ratings. Okay, if you go and look at everything rated AAA prior to the financial crisis, they don't all trade at the same interest rate. Right? The things that were clearly not all that AAA traded at interest rates higher than other AAA assets, meaning the market was not fooled by this. Right? Everybody understood that Moody's is getting paid by the securitizers to produce a certain rating. Right? Therefore, they didn't trade at the same rate. Now, there is an important role for rating agencies. It's a regulatory one, however, right? Not a fraud one. There are lots of entities in the world that can only hold securities rated to a certain level. If you can produce securities that are getting that rating, but that are producing higher interest rates because, in fact, they're not all that good, you create an incentive for those entities to hold what they can with a straight face say, are AAA rated securities, but that are actually producing greater yield for them. One of the few good things in Dodd-Frank is it largely takes out all of those provisions from the law. So in other words, the law is not going to, when we regulate people, we're not going to actually rely on rating agencies anymore. Now here's another thing, all right, about rating agencies. If a security is rated AAA, what does that mean? That it never
So what
loses
are we
value?
going to rely on to rate the
I would rely on
confidence
the
in a bond
market.
or something, on the market?
Yeah.
Okay.
I thought you liked that
You're
answer,
gonna
yeah.
tell me the government.
So then,
It's refreshing, by the way, to be attacked from the right. That almost never happens.
I'm not attacked, I'm just, I'm not
Just discussion.
All right, no, hold on. So here's, when you say that something is rated AAA, right, that doesn't mean it never loses value, right? Imagine you have $1 billion CDO that Citibank is going to sell before the crisis, okay? And then somebody says, look, we've modeled this, it comes out, we think it's worth $1 billion, the market believes it, they'll buy it from us for $1 billion, right? And then somebody says, hey, wait a minute, you didn't factor in the possibility the housing market will crash. I said, oh yeah, I guess I did. I guess I should be, well, let me adjust my model. Right? So let's say there's a 1 in 100%, 1 in 100 chance that this CDO is going to lose half its value because of a housing market crash. Right? Now in fact, it's not going to actually lose half its value in the actual crash, but let's assume that, okay? So now we have $1 billion CDO. We factor in a 1% chance of it losing half its value. You know how much we price it at? $995 million. In other words, nothing statistically different from $1 billion. Right? You can factor in low probabilities of gigantic losses into securities prices. They don't move very much. Right? Anybody who would have paid $1 billion for the CDO, or anybody who would pay $995 million, would pay $1 billion. It's too small a change. Right? The problem with all these events is they're extreme low probability. That means when you price them in, it doesn't make a big difference. Right? If you had priced in a risk of crash into your AAA bond, it wouldn't have changed the price you bought it at. It wouldn't have changed its credit rating. Yeah.
Then, in deference to my friend who brought the subject up, maybe there should be different degradations of ratings. Instead of AAA and AA and B and C, maybe it should be a percentage type of thing that would allow the retail investor, who is very novice in these areas, to more critically judge what he's investing in. Because as you said, AAA means to me, you know, you're bone safe here. I mean, there's nothing can go wrong.
Right, but that's never what it meant. Right? That's just never
But that's
what it
not
meant.
the perception
I
from the retail
understand
investor.
that. I understand that, but that's just never what it meant. All right? And the interesting thing, right, when you look at credit ratings, what they're usually looking at is the so-called non-systematic risk. Okay? If there's a gigantic recession, everything's going to lose a heck of a lot of value.
Or an attack in a different part of the world.
Right,
They spike
or
oil
major,
prices.
right. You know, if the Iranians manage to close the Strait of Hormuz or something like that, there will be gigantic losses for lots of people. That doesn't mean the credit ratings were wrong. Right?
You'll need your crystal ball, but let's say mortgage rates or interest rates go up to 6%. What about all the money, the people that borrow the money, it's great, but what about the people that invested and are holding it? They're gonna lose a little bit of money. How will that affect the whole economy in general?
You're saying if today mortgage rates go up to 6%?
Yeah, well, historically, to borrow money is cheap. You know, so if it goes to 5, 6, 7, God forbid,
Okay,
14%.
If it went to 6% next week, you'd have a catastrophe.
Yeah,
Right.
that's right.
But it's not going to go to 6% next week.
No.
It's going to go to 6% slowly. Right? So I just did a conference at Iowa where one of the participants was Charlie Himmelberg, who does global credit research for Goldman Sachs. And basically someone asked him exactly this question, right? And the argument is, right, everybody's invested in these bonds at low rates. When interest rates spike, the bond prices are going to crash. Aren't you going to get to them? And the answer is yes, if it happens fast, right? But there's just no reason to think it could happen that fast, right? Interest rates don't usually move that quickly. If you go and look historically, you're not going to get a 5% interest rate move, except by intentional action of the Federal Reserve, ever. So why would the Fed do that? I mean, yes, they could, I suppose, but I mean, since it would so obviously be catastrophic, all right, it's hard to imagine they would. So yeah, it could happen, but as long as it doesn't happen quickly, it's not a serious.
What about the September 15th situation with Lehman and everything like that? You know,
Look,
it could have gotten worse.
if you're saying, if something really bad happens, will there be terrible consequences? Yes.
Okay.
All right. Yeah.
Have another drink.
Yeah, I couldn't disagree with you more on basically everything. For instance, your description of the
That's not, that's.
your description of the bubble. I mean, F.A. Hayek won the Nobel Prize for coming up with the concept of the boom-bust cycle, and all the bubbles are artificial credit creation. Like you were talking about the black market and mortgage, or the dark market, shadow market mortgages. those were all based on assets that were overvalued because of the fact that the Federal Reserve pumped in so much
Was the
money.
stock, was the tech stock bubble artificial credit creation?
Well, yeah, you had the Greenspan put, where everyone knew that if anything bad happened, they would always, like, I mean, Greenspan pushed the wealth effect. He wanted people to go out and spend more money.
Why would it affect tech bubble, tech stocks, and not something else? If it's the Greenspan put.
Well, it's just whatever it goes into.
What about the 1920s bubble, or the Nifty 50 bubble?
Well, like the Austrian economists were predicting it from 2001 to 2003 that there was going to be a housing bubble before it even started. So were all these people just like prophets, like they saw into the future? I mean, Ludwig von Mises predicted the Great Depression before it happened. Like they have like a record of predicting all of the crashes before they happen.
I've never seen such a thing.
You look at Ron Paul in 2003 predicted the entire housing bubble, like word for word. Like you can read the speech. You can go on YouTube. It's there. Like how it was going to happen, how it was going to have a massive effect on the global economy.
Then how come there aren't more people like John Paulson who could have made billions on this and didn't? They're just fools.
Not sure
I mean,
what-
if you could actually predict these things, you're able to make tremendous
Well, I mean,
amounts
you can't
of money.
predict the exact timing, like, but if you pump money into the system,
And then you're
it's
like,
going
and
to-
then you're like an economist who predicted 8 of the last 5 recessions.
But they never have. An economist never has.
We have our friend from,
Oh, yes, I
Please.
Please, yes.
Good, please.
From a free market perspective, the fact there was a need for a shadow banking market in and of itself, doesn't that suggest some kind of major regulatory failure? Just at the root of it all. And also, secondly, you didn't get into much into the whole psychological effect too big to fail has had, so we just talk a little bit about
Okay,
that.
so there's a market need for certain types of investments for the institutional cash pools. Why there would be a regulatory failure that need isn't met when the market did come along and meet the need through the shadow banking market doesn't seem obvious to me. Now, you could say that the regulatory failure was from the beginning that we didn't extend deposit insurance to high enough levels of deposits. Right? If you had unlimited deposit insurance, what would people do with their cash? They'd stick it in a bunch of banks, right? And then it'd be insured, and they wouldn't think about it. Right? Since we limit deposit insurance, right? Why do we limit deposit insurance? Right? If you look at it from a left-wing point of view, we limit deposit insurance because we want to protect little guys, but we think big guys should be able to take care of themselves. All right? The real reason for having deposit insurance is to stop bank runs. And if you want to stop bank runs, it's actually more important to stop the big people from moving their deposits than the small people, because it's the big people who will crash the bank faster than the small people. Right? So, but you can imagine the political reaction to saying we should have unlimited deposit insurance. Right? Who wants to guarantee the deposits of the sovereign wealth fund of Saudi Arabia? Right? But that is what you would be doing, right? Along with the deposits of Apple and everybody else. So if there's I'm not exactly want to say it's a regulatory failure, but it is a creature of regulation in that we limit deposit insurance to a certain level. Too big to fail. Look, here's the thing about too big to fail. All right, you have a bank or an institution like AIG or something like that. If everybody understands or at least believes that if this thing gets into trouble, the government will step in and protect it, then you have one problem, which is that entity can borrow at much lower rates than other people. That gives it a competitive advantage and so on. If it turns out, however, that there's an independent good reason for having really big institutions like economies of scale, then you have two choices. You can bust up those institutions and lose those efficiencies, or you can live with too big to fail. Now, there's a cost to every solution. Now, one of the most brilliant things Coase says in the famous article on social cost is that there are no nirvana solutions. Every solution has costs. Right? So if you want big institutions for independent reasons, then you have to live with too big to fail. So how do you limit that as much as you can? you announce ahead of time something like, if anybody gets into trouble, then as long as they have good collateral, we'll lend 98 cents on the dollar or something like that from the Federal Reserve against their collateral. If you announce it ahead of time and you extend it more broadly, in a crisis situation, if we'll lend to anybody who has good collateral, whether they're a bank holding company or not, whether they're currently qualified to go to the discount window or not, you can begin to limit the moral hazard problem of too big to fail. Do you really limit it permanently? No. But it's a mistake to think that you're going to get a perfect solution in the world. Right? If you allow an institution that's too big to fail, you know what happens? You have gigantic upfront costs. Right? Do you want gigantic upfront costs, or do you want uncertain, indefinite costs sometime in the future? If you have a positive discount rate, it might really be good to take the costs down the line that are uncertain, rather than the gigantic costs you have up front. And it's an empirical question, which set of costs is worse. And it's such a bad empirical question, you can't really figure it out, all right, which way it really is. But there's a serious argument for, let's avoid the gigantic costs now to see what happens later. U.S. banking system, here what happened is the U.S. banking system failed to create $4 trillion in assets that are the equivalent of T-bills. Who in the world ever thought it could possibly have done that, right? And it managed to do it for quite a long time. It's a fairly well-working system.
We should take about 2 more questions, and then we're going to cut it off. Mark?
Just my analysis. 'Cause a lot of people, they always look at the problem happened with the crisis. We got to. I think the bigger problems is the government overreaching, like with Dodd-Frank. Like one thing, if you want to segregate accounts, things like that, that's fine. But to overreach and to swap, a lot of the problems happen with the CDO, collateralized mortgage, nothing to do with the swap industry. They totally regulate other industries, just like Sarbanes-Oxley. And I think the good thing is to try to do a balance and try to at least keep perception, faith in the markets. A lot of people think, well, how do you prevent it? I think the main theme is how do you prevent this from ever happening again? You can't. It's a capitalistic market. It can happen again. However, you also have to balance. It's not a casino because everyone has, well, how do we guarantee? Well, you can't guarantee. Well, this is no different than Las Vegas. No. It's not Las Vegas, and it's not. You can't totally guarantee it. It's somewhere in between. And to have perception in the marketplace, that's where I think Dodd-Frank kind of overreaches, and that may eventually just force money out of the U.S.
The late great Larry Ripstein has a really wonderful article in the Houston Law Review, long before the crisis, maybe in the early 2000s, called Bubble Laws. And what he did is he went back and looked, way back to the South Seas bubble in the 1700s, about legislation following bubbles.
Which I think is worse than that.
Yeah, and Dodd-Frank is a typical bubble law. It's passed in haste. It has very little to do with the actual crisis.
And it hits in areas that have nothing to do with it.
Completely irrelevant. And what it usually contains, what bubble laws usually contain, and Dodd-Frank is exactly like this, is a collection of ideas that people had talked about prior to the events giving rise to the law, largely unrelated to the events giving rise to the law, that they really would like to have enacted, but had no opportunity to do so until the crisis.
Never let a crisis go to waste.
Yes, exactly.
Since Mark's was the speech, we're going to take one from Tom, and then, of course, Frank gets the last word, and then we're going to open the bar up for us that need a drink once in a while.
You seem to dismiss the sort of repeal of Glass-Steagall and the separation from investment banking and banking stuff, because that was passed as a result of the Depression, as I understand it. And I used to work for a bank years and years ago, what's happened to the whole sort of concept of safety and soundness and lending policies? Is that just all gone away?
No.
Because that's at the root of the problem of how you got all these, you can call them subprime loans, but it's basically junk mortgages. I mean, right?
So, what happened in banking regulation? Probably until about 1980, right, it was safety and soundness and prudential judgment. And the argument back then was pure quantitative measures aren't good, people can evade them, we need sort of very prudential, individualized judgment. In the early 1980s, that view began to lose favor, and it was sort of permanently cast away with Basel I in 1988. right, followed by Basel II in 2004 and Basel III in 2010. Here, we give up on the individualized decision-making, and we have extremely complex quantitative standards for measuring riskiness. Now, up through 2004, the actual amount of equity capital held by banks largely increased under the Basel regime. Right, so that actually worked pretty well, I think, at least up until that point. One of the problems, and this goes back to the rating agency problem, is by systematizing in the Basel framework the risk weightings of assets, it turned out that asset-backed securities were legally given under Basel very low risk weightings. This encouraged banks to hold them because you had to take a very small charge against capital to hold them, right? So it allowed you to hold a lot of them and get good yield and so on. If you did not have that uniform risk weighting, even across the world, right, in Basel, if you applied in Europe as well, you probably would have had people not willing to hold as many asset-backed securities, and you would have gotten a better result. But that doesn't mean Basel overall was a bad idea. There's a problem with Basel overall, is that by the time you get to Basel III, it is so mind-numbing complex that I can't remember if it was Janet Yellen or Thomas Hoda who might have said, there are like 5 people in the world who actually understand Basel III. That's probably right, and I'm not one of them, just to be clear.
Frank.
Thanks for being here and for the lively discussion. I like the way you started it off by giving the left's version and the right's version. And what I got from that was pretty much that this isn't so much a political problem, but more a systemic market problem, if I'm assessing that correctly. So my question would be, is there a political solution to this or a political remedy? Because from a political perspective, you note that George Bush, John McCain, Barack Obama, and Sarah Palin pretty much all supported TARP. They were all on the same page on what they thought was the solution to this problem. Is there a left or right solution that works better than the other?
TARP is not a solution to the overall problem. TARP is a solution to recapitalizing banks in the immediate aftermath of the crisis. If you're asking if is there a bigger solution to the problem, what happened after the crisis? Where did all this money go? Well, some of it was lost, of course, but not a tremendous amount on an absolute basis. So where did the money go after the crisis? Oddly, it went in a couple of places. One is it went mostly into the new Treasury bills that got sold when Barack Obama blew out the budget. So it's like every bad thing has some good aspects. So by blowing out the budget, he actually created a lot of T-bills to soak up a good part of this money. Right? Now, I wouldn't advise blowing out the budget to do it. What I would do is I would change the mix of debt financing we use, keeping the total amount constant, right, in order to create the kind of assets you need for this money to go somewhere. The other alternative, which was also easy to do, was just lift the cap on FDIC insurance, or just really raise it to some gigantic number, like $1 billion or something like that, so that people who have very large cash bases have somewhere to place their money. And even if you only did it to $1 billion, there'll be people who have a lot more money than that to worry about. But they can start putting $1 billion in each bank. They'll knock it out pretty quick. The number of people who have
presently 250,000.
Yeah.
And when was the last time it was changed?
Recently in the crisis, it went from 100 from 1980 until sometime after 2000.
So you're saying that would have been better than selling off more T-bills and raising the debt instead?
You can sell more T-bills without raising the debt if you sell less long-term debt. You can
But
keep
what
the
did we
total
do in
amount.
the past? We did the opposite, or?
No, but Obama, just by blowing out the budget, sold more of everything.
All right, not
Okay, right.
Could you tie the FDIC insurance rate to the rate of inflation so that as inflation goes up, so does the level
Sure.
of FDIC insurance?
Sure, but you need to you need to raise it tremendously from the current starting point in order to make a dent in the amount of cash we're talking about that's looking for a home.
Thank you.
All right, well, thank you very much, Professor Miller.